Okay, if you're a Canadian homeowner, there's a date that's probably looming in your mind: 2026. Your mortgage renewal is coming up, and let's be honest, after the last few years of economic chaos, you're probably a little nervous about what that's going to look like. Well, guess what? You are definitely not alone. So let's get into it and figure out what's coming our way. First, I want you to just look at this number: 60%. Just let that sink in for a second. It's a massive, massive figure, and it points to a huge shift that's happening right now in the Canadian housing market. But 60% of what exactly? That's right, more than half, 60% of all mortgages in this country are all coming up for renewal in this tight 2-year window. Now, this isn't just your normal renewal cycle. We're talking about a whole wave of homeowners whose last renewal was during the pandemic, when they locked in those crazy rock-bottom interest rates. They're about to step into a completely different world. So let's get to the question that really matters. What does this mean for your wallet? Well, according to the Bank of Canada, the majority of these homeowners are staring down a payment increase, and we're not talking about a small bump. For many, it could be a jump of 15 to 20% compared to what they were paying just a little while ago. That is a serious hit to any family's budget. To really get a handle on the challenge the opportunity of 2026, we've got to take a quick look back at the absolute roller coaster ride we've been on. Trust me, understanding how we got here is going to be key to you making the right call for your renewal. I mean, just look at the whiplash on this timeline. It's wild. We went from those emergency pandemic lows, a rate of just 0.25%. Then, to fight off that crazy inflation, the Bank of Canada slammed on the brakes with a series of aggressive hikes, taking the rate all the way up to 5%. Then, as things finally started to cool down in 2025, they began cutting again, which brings us to today, this stabilization phase, where the rate's sitting in what they call a more neutral 2.25%. What a ride. So, with all that history, you're now at your renewal. And this isn't just about signing on the dotted line. You're at a major financial crossroads. And the big choice you're going to have to make is between a fixed rate and a variable rate mortgage. So let's break this down real simple. A fixed rate, that's your anchor. It's all about stability. Your interest rate is locked in solid, so you know exactly what your payment will be, month in and month out. No surprises. A variable rate, on the other hand, is about flexibility and the potential to save some money. It moves with the bank's prime rate. So that brings us to the million-dollar question. What do the experts think these rates will actually be in 2026? And here's where the decision gets really tricky. The forecasts are showing a 5-year fixed rate landing somewhere between 4.8 and 5.1%. But look at the variable rate. It's projected to be lower, somewhere in the 4 to 4.95% range. So yeah, on paper, variable looks cheaper, but it comes with that risk, that uncertainty. So how do you pick? Well, if you're okay with a bit of risk, the case for variable is pretty strong. Over the long haul, it's often cheaper, and hey, if the Bank of Canada decides to cut rates again, you feel those savings right away. But the argument for a fixed rate is all about sleeping well at night. Your payment is predictable, you can budget perfectly, and you don't have to lose your mind watching the financial news every day. Now, beyond that classic fixed versus variable debate with your big bank, there's another player in the market that's been growing like crazy and giving homeowners some new options to think about: alternative lenders. And when I say growing, I mean it. The growth here is just staggering. We're talking about a market that's forecast to practically double in just 5 years, from around $16 billion in 2024 to over $30 billion by 2029. This is not some tiny niche anymore. It is becoming a major force. So what in the world is alternative lending? Well, it's pretty simple, really. It's any kind of lending that happens outside of the big traditional banks. These are often newer companies, a lot of them driven by technology, and they're kind of changing the game on how people get access to credit. And it's a pretty diverse space, too. You have things like peer-to-peer lending, which is kind of like borrowing money directly from a group of regular investors instead of a bank. Then there's stuff like real estate crowdfunding. The main idea is that they often use tech to help out borrowers who might not be a perfect fit for the old-school banks. Okay, so as we start to wrap this all up, I want to try and shift your perspective a little bit. This 2026 renewal, it doesn't have to just be about damage control, you know? It doesn't have to be just about hunting for the lowest possible rate. This can actually be a really strategic moment for your whole financial life. This quote from some industry experts just nails it. The days of ultra-cheap borrowing, they're over. That ship has sailed. The real opportunity now is to use this moment to restructure, to optimize. Maybe it's a chance to consolidate other debts or to find a mortgage that actually fits your life goals better. It's about making your money work smarter for you, not just cheaper. And that really just leaves us with this final thought. Your mortgage is probably the biggest, most powerful financial tool you have. So as you head into that 2026 renewal, don't just ask, what's this going to cost me? Instead, ask yourself this: is my mortgage working as hard as I am? This is your chance to grab the wheel and turn a moment of anxiety into a genuine opportunity for financial progress.